As frost creeps across Europe this October, the continent stands on the edge of another crisis, not one born from war on the battlefield, but one forged in boardrooms and parliaments. Germany, once Europe's economic powerhouse, now faces losses of up to 40 billion euros this winter if gas reserves run short. France, weighed down by debt, is flirting with whispers of a bailout. Inflation refuses to die down. Factories are closing. And all of this, some argue, because Europe chose ideology over pragmatism. Welcome to Europe's winter of discontent. Not long ago, Europe's lifeblood flowed through pipelines from the east. Before 2022, Russia supplied nearly 40% of the European Union's natural gas, with Germany drawing the lion's share through the Nord Stream pipelines, cheap, steady, and vital for industry. Then came the war in Ukraine. Sanctions were imposed, pipelines went dark, and in September 2022, boom, mysterious explosions tore through the Nord Stream 1 and 2. Swedish probes confirm sabotage, but 3 years later, the world still doesn't know, or perhaps doesn't want to know, who did it. The immediate loss, up to 15 billion euros in damage, but the real cost was far greater, an energy crisis that rippled through every factory, every household, and every economy. In desperation, Europe turned to LNG from the US and Qatar at triple the price of Russian pipeline gas. Germany's new terminals like Wilhelmshaven now hum with activity, but the price tag hums louder. And as of October 2025, gas storage sits at just 75% to 83%. If a harsh winter hits like in 2010, demands could spike by 30%. Frontier Economic warns 40 billion euros in losses for Germany alone. That's 1% of GDP gone, not from war but from cold. Factories could shut down, blackouts could return, and inflation could flare. Germany, once the export king of Europe, now limps along with stagnant growth. After two back-to-back recessions, its economy flatlined in 2025. Why? Energy shock therapy. With Russian gas gone, prices soared. Chemical and automobile giants, industries that rely on cheap energy, began packing up. BASF, Volkswagen, ThyssenKrupp, all are cutting jobs and moving productions to the US or Asia, where gas is cheaper and policy is friendlier. By mid 2025, industrial output had dropped 5%. Energy costs were up to 30% since 2022. And while Berlin boasts about the green transition, the reality is harsher. Nuclear power is gone, renewables are inconsistent, and coal is quietly making a comeback. The IMF estimates that a full Russian gas cutoff costs Germany 2.7% of its GDP. But the Bundesbank warns it could be far worse, especially if winter bites hard. Social media users put it bluntly, saying Germany's climate goals are impressive. They're freezing the economy to prove it. If Germany's industrial engine is faltering, France's finances are cracking. Public debt has soared past 112% of GDP, heading towards 130% by 2026. Deficits are the worst in the Eurozone and bond yields are climbing to levels unseen since 2011. President Macron's austerity plan, cuts, taxes, reforms, has only triggered more strikes and unrest. By 2026, France will pay 75 billion euros a year just to service its debt. That's money not going into hospitals, infrastructure, or jobs. And behind closed doors, some in the finance ministry are whispering the unthinkable. Quote, is an IMF bailout on the horizon? Meanwhile, France's nuclear fleet, once its strength, is plagued by maintenance failures, forcing more gas imports. A cold German winter will send energy prices soaring across the bloc, and France will feel it immediately. The European Central Bank claims victory. Inflation is down to 2.1%, but that's a mirage. In Eastern Europe, inflation is still above 8%. Core inflation, excluding food and energy, remains stubbornly high. Core inflation, including food and energy, remains stubbornly high. And if the winter turns severe, gas prices could double again, adding 2 full points to inflation. The ECB can't cut rates, growth can't take off, it's stagflation all over again. Ordinary Europeans face 20% higher utility bills. Groceries cost more. Wages can't keep up. Meanwhile, Brussels continues funneling billions eastward. Since 2022, the European Union has spent 143 billion euros supporting Ukraine, grants, loans, and arms, all while its own industries crumble. Germany alone has given 25 billion euros, roughly equal to its bailout of Uniper, the gas giant. France, another 5 billion euros, but that money could have revived Europe's own economies, built grids, or subsidized industries. Critics call it economic self-sabotage. The European Union says quote, we're funding a war abroad while dismantling prosperity at home. And they may be right, because every euro sent to Kyiv is a euro not spent in Cologne, Lyon, or Naples. Even the Kiel Institute admits the war has shaved up to 1% of European Union growth each year. Europe's slowdown isn't contained. The UK faces bond pressure. Poland and Austria hoard gas reserves. Romania's inflation hits 8.5%. Italy's debt rises again. It's the same domino effect we saw during the Eurozone crisis, only colder, harder, and this time self-inflicted. Berlin has ordered 90% gas reserves by November. Subsidies are returning. Another 15 billion euros. Renewables are being rushed, but LNG from Norway and the US isn't cheap, and Asia's bidding too. Long term, the European Union talks about hydrogen fusion and climate resilience, but people can't heat their homes with promises. Europe's leaders face a choice: keep pouring billions into a proxy war that's frozen its economy, or reinvest in its own survival. Because if this winter is cold, it won't just freeze gas pipes, it'll freeze an entire continent's illusion of control. Europe wanted to stand up for values, but it may end up standing still, in the cold, in the dark, wondering if solidarity was worth the sacrifice. This is Europe's winter of discontent. Thanks for watching.